All right, so welcome everyone. We're going to begin. I hope you can see my screen. Perfect. Okay. So today we're going to be talking about managing your money. So own your financial future. My name is Ashley Doyle. I'm a professor here at Acadia University. I teach accounting in the business school. And this is a topic whenever I get asked to present on financial literacy topics, I get really, really excited. I'm a CPA, which is a chartered professional accountant. I went to school at St. Mary's University, and then after I graduated, I moved to Toronto and I worked for PricewaterhouseCoopers, where I obtained my CPA designation. I also worked in industry, working for Sobeys for quite some time. I earned my master's when I came here to Acadia University, and I also do a lot of volunteer work, such as chairing Catapult, which I just stepped down from, but I did that for years as well. If you are on campus, if you do come to Acadia University, I'm in Patterson Hall in the business school, and you can come find me on the third floor. So, what is financial literacy and what will we be talking about this evening? Money plays a huge role in our lives in the world that we live in. We benefit from learning useful financial information and the way to manage money effectively. Just like reading to or learning to read or write, learning about money is a process and it's an essential skill for all of us. So we don't just need the right financial information, but we also need to be really confident in applying our skills to our everyday life. So, really, in other words, we need to be able to make good financial decisions. Financial literacy is about understanding how the financial system works. It means knowing about the financial products that you'll be exposed to when you come to university, such as credit cards, and how this can be used for you, not against you. So tonight, what we'll talk about, we'll first start with budgets. I know that's something that you all probably want to know some information on. We'll also discuss how credit works and what you can do to stay out of bad debt. We'll deconstruct credit cards and take a look at what things you buy and how much it actually costs you. Then we will find out why debt mounts up and the impact it can have on achieving your future dreams. You may not believe it, but not all debt is bad. We'll discuss good debt specifically as it pertains to all of you, such as taking out a line of credit or a loan to go to school. And we'll spend the rest of our time exploring some practical ways that you can take control of your money before your money takes control of you. All right, so what's a budget? Sometimes with budgeting, the first and most difficult step is just starting. Many of us struggle to budget for different reasons, but if you look at the many reasons people give, you can put them kind of in two main categories. So, first of all, some people just don't feel comfortable working with numbers at all or reviewing their spending activity. It can bring up a lot of feelings such as anxiety. But really, creating a budget is about putting aside a bit of time and then doing some adding and subtracting, which is often not as complicated as it may seem. Some people may feel nervous about putting on limits on money that they're spending. Um, but really, it's about once you know what your budget looks like, you're able to make a plan and see what you could work on next. There is some flexibility that you can build within it. The reality is that a budget can help be less stressed about finances because you can plan for life's milestones, like that big grad class trip that you want to go on. So it's true that, sometimes budgeting can feel stressful because it's restrictive. It's not something we have to do, so we don't really want to spend much time on it. But thinking about budgeting as something you can use to know where your money is going and how you can control it is really helpful and it's really quite empowering. Budgeting is a tool, it's really not a chore. It's a way to take control of money to meet your goals and improve your financial situation, not to limit you or constrict you. Budgeting is about choices, not sacrifices. So, what it does is it gives you a snapshot of your current financial situation and shows you the way to adjust that situation if appropriate. Try not to see it as limiting you, but see it as making your money work for you. Keep in mind too that budgeting is a work in progress. You might not get it perfect the first time, but it's flexible, so you can change things up as you move along. So, making a budget is basically a four-step process, and it all starts with adding up the money that's coming in. So sometimes with students, you might have your first job. I know when I was in high school, I worked for Dairy Queen, so I had employment income. Sometimes you also have some benefits, such as a GST credit check that you earn. And sometimes you have other sources of income for students. Sometimes I get them to build out their budget and actually put in when they have money because they had a birthday or because they celebrated a holiday and they received money from their parents or something like that. You can actually build that into your budget so that you're identifying that total monthly, we call this term income, that's really just your money coming in. And then next, you want to identify all of the money that's going out. This is what we call expenses. So your expenses are a combination of two things. First, your fixed costs that stay the same each month, and then your variable costs that could change from month to month. So a fixed cost could be something like if you're living off campus and you have rent to pay, maybe you're paying for your phone bill, okay? And variable costs is things that might change. So if you do have a vehicle, gas for your car, groceries, things like that. One way to get a picture of your expenses is to actually collect and analyze your bank statements and credit card statements from the previous month or two to really see where you're spending money. Again, it's not something we have to do, so sometimes we put it off, but it can be very, very enlightening. Another way is to track your expenses each week just by adding up all of your receipts. Either way, the goal here with expenses is to get a true picture of your spending and the patterns that you have. Some expenses are going to occur regularly, but others are going to change month to month. Sometimes even just looking at it and writing everything down can be a real motivator. I'll give you some apps later that you can potentially use, but having a spending journal, an Excel spreadsheet, something like that, and just writing the amounts down, even on a piece of paper, you can compare your actual spending to your budget and tweak it if necessary. If you need to cut down your expenses, a really good activity, I was just talking to my kids about this upstairs actually before I came down to do this session, is to identify what your needs and your wants are. So a need is something you cannot live without. It's like your place to live, your heating, water, food. It can also be sometimes a financial obligation you can't skip out on, such as if you do have debt payments once you borrow money to go to school. A want is something that feels very important to you, but you do not actually need it in order to get by. So, budgeting is really not about cutting out all of your pleasures. Like, there's things that you need to do for your mental health. Maybe that is going out every now and then with your friends and what have you. And it's going to look different for each person. It's okay to keep some of these wants so long as you're paying your bills and you're not getting yourself into a sticky situation. The goal is to make sure you have enough money to spend on your needs and do not confuse the needs and the wants, and to really understand when you're kind of overspending in that want category. If you make a chart listing what the items are, how often you buy them, and how much they cost, then add those up on a monthly basis. Having a chart like this will help you see where you're spending more than you've realized or ever wanted to. And then you can think about ways to reduce that spending and save towards your goals. So, if you do have a part time job while you're going to school, and maybe you do already now, then we need to kind of have a conversation about income tax. So, one of the reasons it's good to know what income you have coming in is that every year you need to file an income tax return, declaring how much income you have had that year. So, say you're working at Dairy Queen, is one of the main steps in filing your taxes. So, you would get a slip from that in order to do so. So, that income tax is charged by the government on individuals and on businesses as well. So, why file income tax? Filing your taxes every year, which we do by April 30th every year, is really, really important, even if you do not owe any income tax to the government. And that's because you may get a refund. So, especially when you're going to university, you're going to have a slip, and we have what's called a tuition refund. So, you're going to get money potentially back with your tuition tax credit. Filing your taxes also allows you to establish eligible room for what we call a tax-free savings account, which is an investment strategy once you turn 18. If you do not file your taxes and have not paid enough income taxes the year before, the government's going to charge you interest on this. And this interest can really pile up over time. To ensure that at Acadia University that we're supporting our students to ensure that they're filing their income taxes, we have what's called a free tax prep services, and this is run by students from the Accounting Society. So this year, for instance, we have a clinic, students sign up, and we actually are helping them to file their taxes for them. This can be really helpful because this is a new concept to some students, especially if they're international. Acadia University has also provided a number of different online budget tools and resources for you to use. You'll see here on this slide that there are some apps that are listed, such as Mint, Pocket Guard, and Good Budget, which can be really useful to use. We also have a budgeting calculator. This budgeting calculator, you can actually break out whether you're a Nova Scotia resident, if you're an international student, if you're living on residence, if you're off campus. From there, you'll see this budgeting calculator that you'll use, and it gives you all of your resources. So this is what we were talking about before, our income. So sometimes students work part-time. They may have scholarship grants. Maybe they have savings that they saved up in high school in order to come to university. And then you'll be able to flow through your expenses as well. Always feel free to reach out to me if you need any help with a template for a budget once you get on campus. So one thing I think is really important to talk about with students is to understand how credit works. So the easiest thing here to understand and have this conversation is talking about a credit card. So what is a credit card anyway? Simply put, a credit card is a set of promises. So the credit card lender, most cases would be a bank, promises to let you use some of its money as long as you promise to eventually give it back. The credit card lender then fulfills its promise when you swipe the card at the store or punch the card into Amazon.com, iTunes, your Apple Pay. Whenever you need to pay someone and you use the credit card lender pays them for you. You fulfill your promise to the credit card lender when you pay them back. So a credit card can be really convenient, especially you have Apple Pay, you're on Instagram and you buy something really quickly, but we need to understand what's in it for the lender. Profit, 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 and lots of it. So every time you swipe your card, the seller or the merchant or the store pays the lender a percentage of your bill. Fees to process most credit cards can range from 1.7 to 3% of the sale. If that item is returned, the merchant has to pay fees on the refund as well. So there's all these different processing fees. And then a big chunk of the profit they make is on charging you interest. So if you succumb to the temptation of buying more than you can actually afford, this can be a really big problem. As long as you pay off your credit card balance in full at the end of each month, then you're going to avoid paying interest altogether. However, if you only pay a portion of the balance, or the worst still, if you only make the minimum monthly payment, then your purchase could end up costing you more than double. So we all know people who believe that they only need to make the minimum monthly payment on their credit card to stay out of financial trouble, but this is wrong. In fact, that is often where the trouble begins. So the minimum monthly payment they give you usually just covers the interest for the month and a tiny bit of the amount that you originally borrowed. So sure, as long as you pay that minimum, it will eventually get paid off, but it will take a very, very long time. The total amount of interest you pay is going to be massive. So to start with, when you pay that minimum payment or a portion of your bill, the most recent purchases are paid off first, leaving items or services you purchased earlier to rack up interest debt as soon as you miss the payment. That interest is charged from the day you made the purchase, not from the date your credit card payment was due. And to make matters even worse, the interest on credit cards is compounded. So with compound interest, interest accumulates on the interest as well as on the principal. Now, there's nothing wrong with compound interest in and of itself. It can be really helpful and lucrative when it comes in your favor, like when you earn compound interest in your savings account. But when you're charged compound interest on the money that you owe, it can be really awful. So let's take a look at this example. So let's say you owe $1,000 on your credit card and the interest rate on the card is 20%. You decide to stop using the card and make the minimum monthly payment, which is $17 in this case, until the card is paid off in full. On the surface, this sounds like a reasonable plan. Okay, $17, I can afford that. But because of that compound interest, you'll be making those 17 monthly payments for many, many months, 238 months or 19.8 years. And so by the time you will have paid off a staggering $3,044 in interest on your $1,000 loan, so triple. The fact is you could have easily found yourself burning hundreds of dollars having this debt hanging over your head for years and getting absolutely nothing in return. The bank walks away with all of that cash, your cash. That's kind of depressing. So if you're curious about how long it would take to pay off your credit card debt if you only paid the minimum every month, just look at your statement. So once you get to university, you may start getting offers for credit cards, what have you. You have to be very careful. Every dollar you spend on interest is a dollar you could be spending on something else. So as you can see, it takes a very long time to pay off $1,000 by only making that minimum payment, because in the early periods, most of the payment is just going towards interest rather than the principal. As time goes on and the payments are made, the outstanding balance will decrease. So economists call this opportunity cost, and this is when the benefits you could have received by taking an alternative action. So pretend it's Friday night, your homework's done, and you're deciding whether to stay in and binge watch Netflix or go down to the common room and brag about finishing your homework with everyone. Both of these are great choices, but you can only pick one. If you stay in, you can't go out. If you go out, you can't stay in. You can't do both. Do one, the opportunity to do the other is lost. So this is the same concept with money. If you spend your money on the latest gadget, that's money you can't spend on textbooks. It's money you can't spend at a restaurant. It's money you can't spend on a trip during spring break. So since you don't have infinite amount of money, the more you spend on one thing, the less you can spend on something else. So opportunity cost is opportunity lost. By now, you're probably convinced that all debt is bad. That's not what I'm trying to convey this evening. But as I suggested earlier, it's really not. There are two different kinds of debt. There's good debt and there's bad debt. So good debt is debt that will pay off in the long run. A student loan, right, is good debt since you're going to get an education out of it that will help you earn more money and give you more opportunities in the future. A home mortgage is another example that can be good debt because a house's value often goes up over time. You'll pay interest, but the payoff in the long run is greater since the value of the home adds to what we call your equity, which is your personal wealth and your assets. Bad debt is debt that doesn't give you that kind of payoff in the long run. So we've already mentioned some things, but typically, anything you consume immediately would be on this list. And bad debt oftentimes is arising from wants rather than needs. There is a car on this slide. Not all car loans are bad, obviously. Modest car purchase that allows you to go to school may be a need for you, but a luxury car purchase for the same purpose is more of a want and may result in bad debt. So I'm sure that many of you are going to have student loans. They're normally recognized as the good debt, right? That money isn't wasted because it's an investment in your education, really, in your future. Um, so that's why loans really usually come from the government. That's also why you don't typically have to pay interest on them until 6 months after you completed your studies or so. The government wants you to make that investment. During that period, you won't have to make payments and you won't be charged interest on your loan. But nonetheless, once that interest begins to accumulate, you will want to get your student loan paid off as soon as possible because every dollar you pay in interest is an opportunity lost, even if it is for a student loan. I think one thing as well to be really mindful of is you get this sometimes large student loan at the beginning of the year. Make sure you're using those budgeting tools to really properly understand that that money may have to be able to pay for 2 semesters tuition, your textbooks, and any other living expenses as well that you're relying on those loans for. Borrowing to buy a car is different, right? Car loses the value the moment you drive them off the lot. So in addition to the purchase price and interest charges, you now need to consider the cost of depreciation when calculating the actual cost of purchasing the car. Again, sometimes a car may be a necessity if you need to drive to work or if you need to drive to school, but you should be able to think about buying an affordable vehicle instead of, that awesome convertible that you saw on TV or something like that. So a line of credit you might have, so these are different than kind of federal or provincial student loans. Oftentimes students take out a student line of credit. So a line of credit works a bit like a credit card in that it is a source of funds that can be readily accessed, at the borrower's discretion, but the interest is paid only on the money that you actually withdraw. Okay. You can usually transfer money from the line of credit and put it into your checking account, for instance, or even to pay off your credit card. So although you have to pay off the interest every month, interest is only paid on the money you actually withdraw, which is a very good thing. That's exactly what you want. Less interest is going to mean more opportunity. One thing that's also really important to talk about with students is credit ratings. So if you're not familiar with the concept of credit rating, it's a number that represents how risky lenders think it is to lend you money. So the higher the credit score, the more confident lenders have that you can actually pay them back. A low score is going to mean that they think you're too risky. A high score means that they think you're safe. So understand that positive information stays on your report indefinitely, while negative information stays for 6 years. So the different components of this, okay, when we look at this, we have to understand that your payment history, your debt credit ratio, how long have you used the credit, the variety of your credit, do you have a lot of new credit, what have you, this is going to impact this score. Certain ways that you can build up your credit in a positive way now or earlier is by putting your the phone bill in your name, for instance, and ensuring that you're paying that phone bill on a regular basis. So I put this slide in here, what's your dream? Because it's really helpful to think about what your financial goals are. So for instance, right now, for my family, we're planning to take a 3-week trip next December together. And we're working together to build that out, to budget, and to identify how we're going to save money for that financial goal. There's things that we will have to cut down on to be able to realize that. So, the real point of being careful with credit and managing your money and your loans and everything is making your dreams come true. Sure, we all want the latest technology, we want good clothes, we want to go out and have fun with our friends. But let's be honest, once we buy clothes and things like that, like how long does that happiness actually last? The less you spend on interest payments and on things that lose their value, the better off you'll be. You don't want to spend your life watching your dreams pass by while you're stressing over payments. So, making the right financial choices now will enable you to achieve your real goals later on and allow you to afford what you truly want in the future. So, exactly what are the right financial choices and how do you go about spending less on interest payments so you can afford more in the future? These are the things that you should be thinking about now. So I popped into the chat a handout. We're not going to have time to do that this evening, but it's a take a situational selfie. If you are, keen, please do fill this out to give you a snapshot. So if the bottom line in your budget is a negative number, you're overspending. So you need to either make more money or you need to spend less. If that bottom line in your budget is a positive number, you are already on the road to owning your financial future. Keep up the good work. So, a good place to start when we think about taking control of our finances is to actually look at your current financial situation. There are some people who find racking up charges on their credit card just way too tempting. And I mean, like social media, all these apps we have makes it so easy to do so. So just know yourself. If you're one of those people, you should consider other options that will allow you to pay for stuff without paying interest. So you can just pay cash. Everybody likes cash. And if you use cash, you know that what you're actually spending. It isn't just a swipe of a card or a beep on a website, it's real cash. And you notice when it goes away. Cash is sometimes great for certain people to curb spending if you're like an impulse shopper. Research actually shows that it is harder for us to part with money than it is for us to swipe our credit cards. So if you want to limit your spending to $100 a week, put that amount of cash in your wallet every week. And once it's gone, that's it. Or you can use your debit card, which I assume a lot of students do. While it's a bit easier to blow money using a debit card, at least you're not going to go into debt and you know what you can spend. Prepaid credit cards work pretty much the same way as well. You can't spend more than you put in. And then, the best way to stay out of debt and manage your money appropriately is to evaluate your spending habits, carefully assess what you are spending on. Are they needs? Are they wants? And find ways to appropriately reduce your spending in certain areas, particularly in that wants category. One of the best ways to take control of your financial situation is to wait until you can afford the things you want before you actually buy them. So, this is what we would call delayed gratification. It's an incredibly important life skill. Delaying a purchase not only gives you time to save, but it gives you time to think about whether or not you need that item. Do you really need it? It takes a bit of self discipline, but delayed gratification will make you wealthier and could even make you happier because sometimes when you anticipate something, you enjoy it even more when you finally get it and it means more to you. So, probably many of you go on a regular basis to go grab some food at a convenience store or a fast food place. Believe it or not, by going to a grocery store instead, you could save enough to take a trip to Aruba during spring break. Let's say you buy food every day at the corner store for $10 that you could have picked up at the grocery store for 8. You probably think, who cares? It's only $2 and the convenience store is open longer. Why bother? Well, here's why. Those dollars add up. After a month, that's $60. After 2 months, it's $120. And after a year, the difference is $730. So $730 could probably pay for some sort of fun vacation or at least go towards it, right? Or maybe even just a flight home to visit your family. Either way, you will be able to afford a change of scene without breaking the bank or paying interest. It's a great deal. All you have to do is head down to the grocery store. Maybe there's better food there anywhere. Anyway, but if you think about it, you can probably save a lot of cash for some of the things you really want by making just slight adjustments in your habits and applying them. So there's another important thing to remember about credit because lending you money is so profitable. There's a lot of competition for your business. So before applying for a credit card, do your research, know what questions to ask. Um, and don't get, so excited because one of these lenders is going to give you an iPad if you take their credit card. Really do your research. Don't be afraid to shop around, talk to them, ask lots of questions and get all the answers to key questions such as what's the interest rate? Is it flexible? Can it be negotiated? How long is the grace period? Meaning how many days after the due date of your statement can you still pay off the entire amount interest fee? Is there an annual fee that's associated with it? Okay. A little bit of work and a little bit of comparison can really make a big difference. So I have some additional resources here as well for you. So as I said, Acadia University has budgeting resources that are available. The Canadian's Guide to Money Smart Living is fantastic. Get Smarter About Money. Financial Consumer Agency of Canada, that's going to give you all these credit card tools if you need to research that. And CPA Canada has a number of different financial literacy resources available to you all as well.